I am asked quite often where I think the market is going. So in this video, I'm going to show you one of the primary indicators I use to get an idea of where the market is going. First of all, I consider every single stock listed on the exchanges as a market unto itself. But for this general question, I'm assuming the broader markets is represented by the S&P 500. For the general market direction, I look to the SPY weekly chart. The SPY is an exchange-traded fund that tracks the S&P 500 index. I use the weekly chart because this gives you a better perspective of the momentum in the market. The idea of momentum is that a market will continue to move in the same direction. At some point in time, this momentum will change. It may not be an abrupt reversal, but just the lack of momentum. A lack of momentum would be a market moving sideways. So I use three indicators that focus on momentum. Here is the long-term chart of the SPY weekly. I chart the price action using candlesticks. Each candlestick in the chart represents the range of trading in its respective week. A red candle means the weekly price closed below the opening price. The open candle means the price closed above the opening price for that week. We won't get too concerned with the price action, so I'm going to switch to a chart where I've removed this price action. Now you see a chart with just the indicators on which I want to focus. There are three main indicators, and I will go through each one of them in importance to me. The first indicator is the exponential moving averages. In this chart, I'm going to use the 20-week and the 40-week. Simply stated, if the 20-week exponential moving average is above the 40-week exponential moving average, we're in a long-term bullish trend. In this case, exponential means that I've given more weight to the nearer-term numbers that make up each of the moving averages. So if the short-term moving average is above the longer-term moving average, we're in a bullish mode. If the short-term 20-week EMA is below the 40-week EMA, we're in a bearish mode. The relationship of these two indicators shows me the current long-term momentum of the market. The second indicator I use is the relative strength indicator, or the RSI. This is located at the top of the chart. I'm using 14 periods. The RSI compares the average up week to the average down week. If the average up periods over the last 14 are greater than the average down periods, the RSI will rise. Bull markets will generally see the RSI in a range of 40 to 80. Bear markets will generally see the RSI in a range from 20 to 60. The 50% level is very important to me. A move across the 50 level suggests a potential change in momentum. In a bullish market, you want to see the average of the up days exceed the average of the down days. The RSI is an oscillator index, so the 50 level marks that change. So if the RSI is above 60, the top of the bearish range, the market looks bullish. The last indicator is the moving average convergence divergence indicator, or we call it the MACD. I'm comparing the 2-week moving average with the 40-week moving average to create the green line. To create the signal line, or 9-period smoothing of the MACD line, and plotting that in red. The MACD is also an oscillator and moves around the zero line. It's important in a bullish environment for the MACD line, the green line, to be above the red signal line. To help you visualize how this indicator helps, I've added a shaded rectangle to the time periods where the MACD line is below the signal line. Now let's add the price action back and see how I combine all three of these indicators to help me get a sense of the momentum in the market. First, we see the 20-week exponential moving average is above the 40-week exponential moving average. This indicator is the slowest to respond to change and therefore the strongest indicator of long-term momentum. The RSI measures a shorter period of time, 14, and will react quicker to a change in momentum. The MACD at the bottom is the fastest indicator because it uses 9-day smoothing. Now let's put this all together to see where we are at this point in time. The 20-week is above the 40-week. The RSI is at 73. Those two suggest we're still in a bull mode. The MACD at the bottom is moving sideways. That suggests momentum is slow at this point in time. Momentum is not binary. It's not just up or down. It's up, down, or sideways. So right now the momentum looks sideways. If the market momentum starts down, the MACD will show it first. Be cautious on new bullish positions if the MACD is going down, and especially if the MACD is below zero. A move below the 50 level on the RSI is a cautionary sign for the bulls. I have highlighted 4 occasions where the RSI moved below 50. In all 4 cases, you can see some significant downside to the SPY. To give you a better perspective of how this can be useful to you, let's go back and look at a period from 2006 to 2010, or what we call the Great Recession. First, at the bottom, you notice the MACD started moving down in mid-2007. It actually crossed the zero line in January of 2008. The MACD line corresponds with the 20-week moving average going below the 40-week moving average. At the top, you will notice the RSI putting in a series of lower highs and lower lows. The first cross below the 50 level took place in July of 2007, a full year before the market started down hard. You can see the 20-week EMA stayed below the 40-week EMA until the July-August period of 2009. The dead low of the Great Recession was on March 9th. If you simply adhere to the concept that the 20-week needs to stay above the 40-week to be in a bull mode, you would have had 6 to 8 months to prepare for a large drop that started in August 2009. So the next time you want to know where the market is headed, consider using this set of indicators to help you see for yourself. Look for yourself and don't listen to the financial news media. This is Doc saying until next time, stay hedged.